Most traders fail not because of poor strategy, but because they don't stick to their own rules. This guide cuts through the hype and shows you exactly how to start day trading as a complete beginner, from choosing the right platform to executing your first trades safely. What is day trading and how does it actually work? Day trading refers to the practice of buying and selling financial assets, such as stocks, ETFs, or options, within the same trading day, with the goal to profit from short-term price movements. Unlike long-term investors who hold positions for months or years, day traders close all positions before the market closes to avoid overnight risk. The core idea is simple. Buy low, sell high within hours or even minutes. You might buy 100 shares of a stock at $50, watch it climb to $51, and sell for a $100 profit. Do this successfully multiple times per day, and the gains add up. But it works in reverse too. Losses can accumulate rapidly when trades go against you. Day trading differs from swing trading, which holds positions for days or weeks. Day trading suits aggressive traders who can monitor markets in real time, while swing trading works better for those who prefer a less time-intensive approach. Day trading requires intense focus, quick decisions, and the ability to handle rapid price movements without panicking. Starting day trading in 2026 requires specific tools and capital. Here's what you actually need before making your first trade. Capital requirements. Beginner budgets should be realistic, with recommended starter capital of $500 to $1,000 for Forex or $2,000 to $5,000 for futures. For stocks, there's a major rule to know: the pattern day trader regulation. You are classified as a pattern day trader if you execute 4 or more day trades within 5 business days, and once flagged, you must maintain a minimum equity of $25,000. However, there are legitimate ways around this. A cash account is the simplest way to avoid the PDT rule, because you aren't using borrowed funds or margin, so the pattern day trading rule does not apply. You can also trade Forex or futures markets, which aren't subject to the PDT rule, or use offshore brokers, though these carry additional risks. Platform and tools. You need a reliable trading platform with fast execution, real-time data, and advanced charting. Top platforms for 2026 include Interactive Brokers Trader Workstation for advanced traders and Schwab's Thinkorswim for powerful charting and analysis tools. Most brokers charge platform fees ranging from $20 to $150 monthly, plus data feed costs of $10 to $60. Technical setup. A stable internet connection is non-negotiable. Consider a backup connection that costs $30 to $70 monthly to avoid missing trades during outages. Many successful traders use dual monitors to watch multiple charts simultaneously, though you can start with a single screen. Choosing your market, stocks, Forex, or crypto. Do not try to master all markets at once. This will divide your attention, and it may take longer to learn to day trade. Pick one market initially and focus your learning there. Forex. Currency pairs like EUR, USD trade 24 hours during weekdays. You can open an account here with as little as $100, but beginning with a little more is recommended. Forex offers high leverage, meaning you can control large positions with small capital, but this amplifies both gains and losses dramatically. Cryptocurrency. Crypto markets operate 24/7, creating a fast-paced environment with higher volatility, meaning opportunities for quick profits can arise around the clock, but so can the risk of significant losses. Bitcoin and Ethereum are the most liquid options. Crypto day trading requires exchanges with fast execution and strong security features, essential day trading strategies for beginners. Having a tested strategy prevents emotional decisions and random trading. Here are proven approaches for beginners in 2026. Moving average. Crossover. This trend-following strategy uses 2 moving averages, a fast one, like 9 period, and a slow one, like 21 period. When the fast average crosses above the slow average, it signals a potential buy. When it crosses below, consider selling. This strategy works best in trending markets, but generates false signals during choppy sideways price action. Support and resistance trading. Identify price levels where stocks repeatedly bounce, support, or get rejected, resistance. When price approaches support with buying volume, enter long. When it hits resistance, consider taking profits or shorting. This strategy requires patience. Wait for clear bounces rather than predicting where support might be. Breakout trading. Stocks often consolidate in ranges before making sharp moves. When price breaks above resistance with high volume, it signals momentum. Enter the trade as the breakout occurs with a tight stop loss below the breakout level. The risk is false breakouts, where price briefly breaks out, then reverses, triggering your stop loss. Pullback strategy. After a strong move up, stocks typically pull back before continuing higher. The stock should not retrace more than 50% of the initial move, and ideally will pull back to the support of the 9 EMA. Buy when the trend resumes with a green candle breaking above the previous red candle's high. This combines trend following with strategic entry points for better risk-reward ratios. Here's the uncomfortable truth. Risk management matters more than your trading strategy. Never risk more than 1 to 2% of your capital per trade. Consistent risk control is what separates professionals from beginners. Position sizing. If you have a $5,000 account and risk 1% per trade, that's $50 maximum risk. If your stop loss is $1 per share, you can buy 50 shares. If your stop loss is 50 cents per share, you can buy 100 shares. This calculation ensures that even a string of losses won't devastate your account. Stop losses are mandatory. Every single trade needs a predetermined stop loss, the price at which you'll exit to cut losses. Place stop losses based on technical levels, not arbitrary percentages. If you're buying at support, place your stop just below that support level. If support breaks, your trade thesis is invalidated and you should exit immediately. Daily loss limits. Set a maximum daily loss, like 3% of your account. If you hit this limit, stop trading for the day. Approximately 80% of day traders quit within the first 2 years, often because one bad day spirals into massive losses through revenge trading and emotional decisions. Trade frequency control. Quality over quantity always wins. Beginners often overtrade, taking 20-30 trades daily and hemorrhaging money through fees and poor setups. Aim for 3 to 5 high-quality trades per day, maximum when starting. Professional traders often take fewer than 10 trades daily. Your first 90 days, the beginner timeline. Days 1 to 30, education and demo. Trading. Don't touch real money yet. It's best to start small, ideally with a demo account and a focus on learning risk management before trading real money. Open a demo account with $10,000 virtual money and practice your chosen strategy. Watch how markets move during different sessions. Study candlestick patterns. These visual representations show open, high, low, and closing prices for each time period. Track at least 50 demo trades in a journal. Record entry price, exit price, reason for trade, and emotional state. This data reveals patterns in your decision-making and highlights mistakes before they cost real money. Days 31 to 60. Small live trading. Fund an account with capital you can afford to lose completely. Start with the minimum position sizes your broker allows. Your goal isn't profit. It's executing your strategy correctly and managing emotions with real money on the line. The psychological shift from demo to live trading is massive. Fear and greed become real when your rent money is at stake. Set process goals, not profit goals. Instead of making $10,000, aim for following your trading plan 100% of the time or risking only 1% per trade. These behavior-based goals give you complete control over your success. Days 61 to 90. Evaluation and refinement. After 60 days of live trading, analyze your results honestly. What's your win rate? What's your average win versus average loss? Are you following your rules consistently? Use 2 checkpoints before sizing up. A 60 to 90 calendar day rolling stability gate to ensure consistent execution before increasing position sizes. Overtrading, taking every possible setup because you're bored or trying to force profits. The market doesn't care about your bills or your desire for action. There are some days when there aren't a lot of great opportunities, and the worst thing you can do is force it. That's when the big, unnecessary losses come in. Revenge trading. Losing money, getting angry, and immediately taking a bigger trade to win it back. This almost always results in even bigger losses. Take a mandatory 15-minute break after any losing trade before considering another entry to reset emotionally. Poor record keeping. About 50% of day traders fail to comply with regulations in their first year, and the average fine for non-compliance is $10,000. Keep detailed logs of all trades with timestamps for tax purposes and to track your performance accurately. Unrealistic expectations. Social media traders showing six-figure gains are either lying, risking absurd amounts, or representing rare outliers. Trading is risky, and most day traders lose money. Success takes months or years of dedicated practice, not days. The psychological battle, mastering your mind. Day trading is 80% psychology, 20% strategy. You can have the perfect setup, but if fear prevents you from pulling the trigger or greed keeps you in too long, you'll lose money. Patience is profitable. The best traders wait for perfect setups that meet all their criteria. Amateurs trade out of boredom or FOMO, fear of missing out. If your strategy requires 3 confirmation signals, don't trade with only 2. The market will give you another opportunity. It always does. Emotional detachment. View each trade as one of thousands you'll make in your career. A single loss means nothing statistically. A single win means nothing. Only your results over 100+ trades matter. This perspective helps you follow your rules without emotional interference. Is day trading right for you? Start with education and demo trading. Move to small live positions only after proving consistency. Focus on risk management above all else. Master one market and one strategy before expanding. Set process goals rather than profit targets. Keep detailed records. And most importantly, never risk money you cannot afford to lose completely. Day trading can provide income and flexibility, but it demands discipline, patience, and emotional control that most people struggle to maintain. Be honest about whether you have these traits or can develop them. If you do, the journey begins with that first demo trade. Take it seriously, learn from every mistake, and remember that every professional trader started exactly where you are now, knowing nothing and trying to figure it out.